Okay, friends, everybody, welcome to another 180 Markets Company webinar. And friends, from an investment point of view, if you can ride mega trends and then express those trends with the best in breed companies, well, that is certainly giving yourself a fighting chance in the investment market. And the mega trends we're going to discuss today, there are two of them, which is private credit growth and asset manager growth. And best in breed is Qualitas. And I am joined today by a long-term friend of mine, and I'm very glad to say he's a friend, Andrew Schwartz, co-founder and managing director. And with that, Andrew, welcome.
Thanks a lot, Greg. And that's a very nice introduction. So thank you very much.
Okay. Andrew, as we were joking around before there, you're a 17-year overnight success. Maybe even though private credit growth is in vogue right now, this is not your first rodeo and you haven't shown up late to the party. In fact, you're kind of early. Maybe take us back to those days of the GFC or post-GFC, if you will.
Yeah, well, I remember it pretty well because when we started 17 years ago, private credit in Australia wasn't really well understood at all. And but both in terms of from an investor's point of view and a borrower point of view. So I recall talking to the borrowers and saying, we can provide loans. And, they would look at you and say, but isn't that what the banks do? How do you provide loans? And on the investment side, it was the same argument in reverse being, but isn't that the domain of the banks? How's somebody who's not a bank going to do it? So we've come a long, I'm happy to say, Greg, we've come a long way since those early days.
Right, exactly. And then maybe bringing it all the way forward to today, and we'll jump around a little bit, but you just wrote a thought piece, which I thought was really interesting about the credit cycle and the property cycle. And for anybody that has listened to a lot of your very recent announcements and so forth, you're certainly bullish on the property cycle, especially Sydney residential. But you could see a dichotomy taking place. Can you just talk to us about those two factors?
Yeah, often people think that the real estate cycle and real estate credit cycle is spinning in the same orbit. And in fact, what I was trying to point out in the opinion piece is there are different factors affecting each of those markets and investment allocations. In the real estate cycle, it's really about interest rates and cash flows that really affect where you are in the cycle at any one point in time. And the credit cycle can be much more about the quantum of capital that's really looking to invest into alternative credit and how mature the cycle is getting from a market participation point of view. And I do think investors can mix up both of those cycles. And really what my thought piece was trying to do is say, well, I think one of them is more mature than the other.
Right.
And can you, before you go into my thought piece, can you actually guess which one is more mature relative to the other? Because I suspect most people think about it back to front. And that was really the background to the thought piece, was really drawing out that they are two different cycles driven by very different things.
Right. And I'm going to tie that again in a second here. But getting into Qualitas specifically, can you just tell everybody who's not necessarily familiar, you have a lot of long-term institutional capital, and it's been growing at a huge rate. But can you just talk about that investment base, if you will?
Yeah, so we're an ASX listed entity. We're 9.5 billion of assets under management. I think that the biggest, and of that, 75% of all of our assets is in the form of real estate private credit. So that's really what we're best known for in the market. But I think the strength of the firm resides in the fact that 81% of all of our investors are institutional. So that could be pension funds, sovereign wealth funds, and I think they're large commitments, very large relationships. They're very sticky in terms of how long they've been associated with our firm. And we're very much seen as that deep institutional player in the market, which I'm sure you're going to ask, why that matters, but, really provides competitive, positioning for our firm.
Yes, exactly. And we're going to get into all that. But I had a thought after reading that thought piece, which is if for some reason some of the newer credit players their loans were going to perhaps trade at a discount or something was going to happen. Given that you have this institutional wall of capital, if you will, you have these deep relationships, could you potentially be in a very opportunistic spot, Andrew?
Yeah, I think the answer is the potential is always there for that at the moment, where again, one of the misunderstandings of credit, Greg, is that everyone thinks about it as one market.
Yeah.
And, they read newspapers about, various players and what may or may not be happening, with, other parties, and they see certain behaviours in the market and they say, but isn't that the whole entire market? And that's a bit like me saying, oh, real estate in Australia is really, really great at the moment. You go, but Andrew, what are you talking about? You're talking about residential,
Right.
commercial, industrial, retail. You're talking about every major city, or you're talking about the regional areas. And credit is exactly the same. It's a bifurcated market. You've got sub-segments of the market. And I think that, where you're dealing in small loans, small check sizes, more retail-y, based
Right.
capital that doesn't have a high level of accountability about the capital, you can see, some, relatively, how do I express this, more edgy type transactions that might be
Yeah.
going on there. And I guess the benefit of Qualitas having large institutional capital is that if we saw market disruption down at that small end, we could certainly, through our tactical credit mandates, really take advantage of some of that dislocation. So you're absolutely right that that is definitely an opportunity for us.
Right. And you mentioned it a couple of times now, institutional. And Andrew, you've always had a vision for Qualitas. And I recall, even when it seemed maybe a little bit extreme, you've always had this institutional vision. In fact, I can tell a story here that I believe you hired some people at a multiplex when they, I guess, were out of work. And at the time, a lot of people thought it was a little bit extreme, if you will, overspending or whatever it is, but it just shows the level of detail and the level of institutional quality that you wanted to build. Just talk to us about that vision.
Yeah, I think there are two different ways that people go about being in the credit business. And one, I think, has more emphasis on finance, and the other one has more emphasis on property. And what I find is a lot of people say, well, if my loan to valuation is at a reasonable level in percentage terms, and I've got a personal guarantee if I'm doing a construction loan, I've got a fixed time price contract, I've got the right security, tick, 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 I'll give the loan. And I'm not saying that's terrible in how people want to go about that, but it's just not our way, right? We say they're really important things, but we're fundamentally property people, right? So it's really about understanding the quality of what it is that we're actually lending against. And so to that extent, I think that what Qualitas has done well is not only have we hired finance people, but we've hired, and I'm not trying to be disrespectful,
Yeah.
but people we call our sticks and bricks people, right?
Right.
Like they really, really understand the fundamentals of what makes good real estate. And the reason we hired back then two people out of ex multiplex developments and constructions, one of them being a licensed builder, is
Right.
because understanding built form is absolutely critical, particularly when you're doing project financing, so you're not just ticking boxes. And if you've ever had the pleasure, use that word cynically, but if you've ever had the pleasure of actually going to a project control group meeting, you could be forgiven for walking out of a building PCG meeting and saying,
Right.
were they even speaking English?
Okay.
Right? Because it is so technical what they talk about. And so I think you have to bring those technicians in, and it's really served us well for 17 years.
Yeah, and the record speaks for itself. But Andrew, can you just talk to us about your investment process? Because I must say, from what we have seen, you as in Qualitas is incredibly detailed.
Look, I think that, again, there's always different ways of running every model, Greg. And, it comes down to who do you really see as your client as the most
Right.
important thing? And we see that fundamentally as our investors, those that have entrusted us with their capital. And bear in mind, we're largely a discretionary manager, meaning we make the decisions of what we want to invest in. So a lot of accountability sits with us in terms of those decisions. And so we're forensic, where,
Right.
we get right into the detail, particularly around not just the borrower and their financials and what other projects they've got on the go and their cash flows, but we're as forensic about the underlying real estate itself, planning approvals. We'll have investment committee meetings if we're doing apartment developments where we will, and this regularly happens, we will put up on screen the actual plans, the floor plans of the apartments that have probably already been sold that we're
Right.
lending against, and we'll go, we don't like that corridor, and it's not northeast facing, it's southwest facing. We don't like two bedrooms that might be adjacent, abutting themselves, so that there's no noise barriers between them. It's really about the fundamentals of the ultimate real estate itself. And often things might come back to investment committee 2 or 3 times where we've
Right.
really had some serious debate about it. But you've also got to understand our market, we run concentrated portfolios, right? So our
Right.
market is not doing little loans of 10, 20, $30 million and
Right.
passing the hat around to investors. What we're doing is our average check size is 80 million. Last year, the year we're in at the moment, 65% of every check we've written has been in excess of $80 million. We regularly write $200 to $500 million checks. The biggest
Right.
one we've done not that size matters, but
Right.
the biggest one we've done to date is a 700, just shy of $700 million investment. It's not lighthearted. It's not, it
Right.
feels good, let's just give it a go. Right.
Yeah.
This is a very, very detailed analysis of what we do. And the bottom line of that is our track record is really strong, and very easy to due diligence when you're an institutional investor to really, and particularly after 17 years, to say, look, they've not fluked it for that long. They've actually got a lot of acumen in respect of what
Right.
they're doing. So I think it has worked well for us. And I've got no doubt if you ask people in the market, particularly perhaps some of our borrowers, they go, look, Qualitas can be really invasive in what they do. But I would probably say, but then equally, we're not trying to be the banker to the entire market. We're trying to deal with the biggest and the best and the most credible people out there who really hit our return profile. And that's why we do what we do. So I hope that answers the question.
Absolutely. And to give you feedback, your reputation in the market is certainly firm but fair. So those
Thank
are the
you.
two words.
I appreciate it.
Those are the two words that come. Andrew, I have to ask this also more detailed question, and at least you have an audience of one here. How do you would the job is, so to speak, to get money out the door for Qualitas, but at the same time, how do you balance that with saying no to loans that, frankly, are pretty on the edge? Like it's easy to rule out the absolutely nots, but those maybes, how do you internally, you, Mark, and Henry, and the team, how do you decipher them?
Well, firstly, we're in the business of as much about what we don't do
Yeah,
relative
that's
to
what I'm
what we
talking
do,
about.
right? Like we're all limited by time. So it's spinning your wheels on an investment that was never going to fit our portfolios really doesn't make sense for anyone, including the borrower, right? On the other side, because if they want to work with parties that they can have a high level of certainty about completion. And so the thing that we do here is we take initial investments through what we call, it's a very technical term, Greg, we call it our heads up process.
Okay.
And, and basically we really look at in the heads up stage, which might go for, three or four pages, conceptually, what is the investment proposal? We're looking at who the counterparties are. Roughly 70% of all of our loans are with repeat borrowers. So again, we're not trying to be the financier to the entire property industry. And so we'll take it through a heads up, which at least gives it like a credit blessing as
Right.
far as the investment team knows that this is an on-strategy investment for us. And then it'll, go through a very detailed due diligence and ultimately come back to the investment committee after that. But I can only describe it as it's a multi-stage, investment approval process. And maybe the other thing I'd say is, we're not a majority investment committee either. We're either all in or we're none in. So
Okay.
if you've got a concern as an investment committee member around the quality of the investment, effectively every single person has a veto right around the table. And that really creates a lot of accountability on those members, because you can't get away with, well, I didn't like it, but the majority want to do it. We all
Right.
have to like it or we're not doing it. And I think that's also worked well for us.
Yeah. And also, speaking of, you said it's circa 70% repeat borrowers. Does that also bode well for maybe we'll turn towards competitive advantage in a second, where conceptually any financier could always win on price, price, and price. But if 70% of people are coming back, that means that it's more than just the price for Qualitas that is making these developers want to work with you, isn't it?
Yeah, they know we've got substantial capital. The industry term is dry powder, how much
Right.
capital's committed to our firm that we've not yet invested. So they know that, we've got dry powder as a firm to make further investments. They know that we're fair in our dealings, and I think all of those things go really well for us. But what they also know is we're not here to do every investment, right? That's
Right.
not like if you work at one of the trading banks, they may say, look, our goal is to be the financier to the Australian property market, and we
Right.
want to have a 25% market share, right? I don't think like that. My goal is to do the best I can for my investors. I want to max out on my return profile, and I'm looking for the best investments in Australia that is really going to hit my fund risk adjusted returns that I'm looking for. So we're not trying to do every single investment in the country. I'm trying to find the best of the best. And I think that what that means is if you're a developer or you're a borrower and you come to Qualitas and we say, Greg, we're going to work with you, it's a
Right.
stamp of credibility for you, right? It says you're of a quality that we want to take into our firm as our partner. Yes, you're a borrower, but you're our partner,
Right.
right? And I think that people want to work with Qualitas because it gives an underlying level of confidence about the quality of the project as well. So that is why I think a lot of people enjoy being our partner.
Right. And also, could it even create some what I would call a healthy I don't know if competition is the correct word, but you're working with these developers, maybe you're looking at it slightly differently, and you're pushing them to be the best version of themselves, so to speak.
100%. That's right. Because, we're looking for best in class, developers and partners. So that's right.
Right. Now, you need the right partner, but you also need the right market, Andrew. And maybe tell us a little bit about your views on overall markets right now, especially if you could focus on residential Sydney, because I know that that is a big area of focus for you.
Yeah, it's true. 77% of everything we do is in residential. We've also that's through both our debt and our equity focus areas. Not a well-known fact about Qualitas is that we own 50% of a build-to-rent platform as well. So we're really big believers, and that's an equity strategy for us. The platform name is GQ. It has a $1.2 billion equity commitment. So that means we can do gross assets of about $2.5 billion worth of BTR development.
Uh,
And I think, that does represent a very substantial business for Qualitas going forward. But we love the residential sector. I know you know this because, we obviously talk offline, but I spent a lot of my time overseas
yeah.
talking to capital CIOs all over the world, right? So I have the privilege of knowing how they think about the US and Europe and places like Australia. And we have so much going for us in Australia, not partly because of geographical remoteness, and lack of geopolitics in the country, but also the fact that we have a critical housing shortage in Australia. These statistics are, national vacancy rates being at 1.5% are not, sort of necessarily a made-up statistic. And often people can question, the statistics. And what I point to is I say, if you look at interest rates at COVID, when we had the emergency cuts come through, interest rates were 0.1%, right? From there, we peaked at 4.35%.
Right.
It was the peak interest rate, cash rate. And in every other market, and I've been doing this for, I'm embarrassed to say, but I'll say 40 years, in every other market that, I've worked in, housing's been very elastic to interest rates. Right. So interest rates go up, housing would pull back. Now, you would say, well, if interest rates went up 4.25%, you would have thought the housing market would have absolutely swung back quite hard in Australia.
Yeah.
So why did it go up, right, is the fundamental question. And the reason it went up is because there's no supply in the market. You're allowing circa 400,000 immigrants to come to Australia and enjoy what Australia has to offer.
Right.
And you've got organic growth all up giving you that 450,000 population growth. And you've got infrastructure spending that's going on. It's difficult. You've got planning constraints. You've got debt capital market constraints. It's not easy to get supply into the market. And as a result of that, you've got very stable asset pricing. If not, you're seeing housing go up since COVID. And if I overlay that then to, well, now it would appear interest rates have peaked. We've had 2 interest rate cuts. The last one was only 2 days ago. And you add that to the fact that our population's continuing to grow, and you add that to the fact that we've still got a very tight vacancy issue in this country. I think there's a lot to feel really positive about as an asset class. And so as a lender, if I feel I'm dealing with a very, very stable asset class, then that gives me a lot of comfort. If I put an equity hat on, I think that rents will continue to go up in Australia. I mean, Sydney is a really good example of that. Totally landlocked city, bounded by, mountains and water. You can really only go up unless you're going to the west. And I think as a result of that, you find that rents escalate above inflation rates. I say that with a bit of sadness for affordability reasons. But rents go up faster than inflation, and I feel that makes for a good investment proposition. So as you can see, I'm excited by housing. I love that sector of the market, and it's a really big part of our business.
Right. And again, can you just look at Sydney in particular, maybe compared to the Brisbanes of the world or the Melbournes? Why Sydney?
Look, we're active right across all of those markets. I'd roughly say we're 35 to 40% in each of Melbourne and Sydney, and the balance in Brisbane. So we're active up and down the eastern seaboard. I think every market is nuanced though. Sydney it's expensive, like by all world standards. And you look at, if I sort of wind the clock back 5 to 7, 8 years ago, and I remember thinking, 15,000 a metre in Sydney was a lot compared to Melbourne, and then we started talking about 22,000 a metre, and then I remember the first time I heard people talking about 30,000. You go to 2025 premium, waterfront property, people can be talking about 70, 80, 100,000 a metre for premium real estate. It's seriously one of the most expensive markets. And I just think where land prices are at, Sydney has a better ability to get the revenue, the values you need to make projects feasible. The issue with Sydney is there's not a lot of builders around, unfortunately, partly because of COVID, but you're also dealing with a lot of, builder developer, type players in the market. Brisbane in the past had the affordability factor. Having said that, it's had a good rise in property, but very difficult to get builders in Brisbane because of the infrastructure spend that's going on and the housing boom that's going on in Brisbane. And then Melbourne, funnily enough, is now the most affordable city in Australia, right? It's been in doom and gloom for quite a
Right.
while. But I think there's a lot of effort and a great initiative that is being applied to Melbourne to overcome that. And we're personally seeing quite a turn in the market in respect of the attitude of off the plan purchases, as an example. So I think you've
Right.
got to, again, not think of real estate as one asset class, but go quite specific and look at the dynamics of each of those cities.
Right. And then also adding to that is one of Qualitas's competitive advantages that you can be very nuanced and go right for those builders or those developments that you really do seek out, so to speak, whether they're on in Sydney, as you said, Melbourne, Brisbane. It actually could depend even on, the street and the development itself.
That's 100% our strategy, right? We
Right. Okay.
know at any point in time what it is we're looking for,
Right.
because we might have, too much of this sector of the market, or not too much, but we've got enough of it. So let's balance the portfolio by looking at another type of investment in a different location with different characteristics. Also, we're trying to achieve a target return. We're mostly exceeding it. And from our point of view, when we're trying to achieve those target returns, it's also about, what's the right risk adjusted outcome for us relative to where the portfolio is at any one point in time. So we know what we're looking for, and
Right.
when we want it, we really go out and get it.
Right. And Andrew, us as investors, we really take advantage of that ourselves because, and just, we really haven't spoken much about the Qualitas, the headstock or QRI, but in this case here, we'll start out with QRI. We have the ability to effectively directly participate in these loans, don't we?
You do. And, I think our model is really about one of efficiency. We listed a vehicle, its ticker code is QRI, the Qualitas Real Estate Income Fund. We listed that around six years ago with the benefit of really offering investors two main goals. One was to the maximum that we can, capital preservation. Now, we've got a
Right.
very good track record, and but we have been, very focused on when people invest with us to the maximum of our ability that we preserve capital. But the other thing is that you get regular income on a monthly basis, and it's been delivering around that 400 to 500 basis points above the cash rate. And it's a bit
Right.
like getting your pay every month. You know the date it's going to hit
Yeah.
your bank account. It's literally every month, as I said. And it's been really popular for those that are looking for an income, type of product. But then, there are others that want to be at the manager level and
And
enjoy
that's
the
what I was going to
benefits of,
say.
well, yeah, and enjoy the benefits of having, having, a business that's managing all of this capital as opposed to the investment of the capital. So, we find a lot of people do a bit of both, is the truth.
That's
Yeah.
join the club. Yes, exactly. And speaking of the Qualitas at the headstock level, conceptually, we have this wall of capital coming into Australia from the super funds and, as you said, offshore capital as well. But can you just give our audience, Qualitas, just some of the growth numbers of FUM and earnings? Because it really, as you said, the track record speaks for itself.
Look, we've been going for 17 years, and we've been growing at a CAGR of 30% per annum. And so, it's been very, very substantial growth, but I would say disciplined growth at the same time, because if you want to go undisciplined, you could actually grow more than that if
Sure.
that's your business model. I don't think we need to grow more than
No.
30%. That's pretty good growth, and it's very strong growth. And I think what's happened, Greg, so if you're where we started this conversation today, was me saying, 15 years ago, people didn't even understand how you could lend money if you weren't a bank. And you fast forward, 15, 17 years, private credit is quite an addictive investment area when you think about it, right? We're living in a world of volatility,
Right.
and you're reading something in the newspaper every other day that, as an equity investor, says my stocks or whatever it may
Yeah.
be is has a volatility about it. Private credit, you agree an agreement with a party about you're giving it's a pretty simple agreement. You're giving them money. They're going to pay you interest every month, and then they're going to pay you
Right.
back. And it's pretty simple. If everyone sticks to the rules, then you know what your rate of return is. And so long as you've really made sure you've got the right security and the right borrower, and not find yourself in a bad situation, then everyone does really well. And I think for a lot of these big investors, when they really come to understand that the risk-adjusted returns are so superior, it is really addictive for them, right? It's really about
Yeah.
how do we get even greater exposure. And the part about Australia is our addressable market is known as the commercial real estate debt market, and that grows between 4 and 8% per annum because of the
Right.
growth in underlying real estate values, but also more residential development. I think it is over three levels gets classified as commercial real estate.
Okay.
And that's mainly what we're participating in, and you've got a situation where the traditional financiers, let's call them the banks, are
Right.
heavily
Pulled back.
regulated.
Yeah.
And, for them, they're not necessarily wanting, in percentage terms, want to grow their property portfolios as a percentage of their total portfolios. And so it opens up a gap for these large alternatives such as Qualitas to really play in that gap. And that's the opportunity that we've, really been, playing in for the last 17 years.
Right. And it's been, as you said, the market really has exploded in the last circa 2 or 3 years. There's obviously a story in the AFR all about it. But Andrew, I want to ask you, you're the co-founder. This has really been from a business point of view, I assume your life's work. But also, the other thing that's pretty amazing is, especially in the top level, the stability of the team. But just talk to us about that,
Yeah,
just the
I think
journey.
that, yeah, we've had a core group of us that formed 17 years ago. I co-founded the firm with a gentleman by the name of Mark Fisher, Greg, who I know you've met
Yeah.
on,
Yes.
several occasions.
Yes.
And, Mark's been an incredible partner for, that period of time. And to his benefit, he's had the opportunity of working with me for literally 20 years because we worked together before we started Qualitas. But to his detriment, he's worked with me for 20 years as well. But we're still together, and
Right.
it's the founding partnership is very, very strong. But we've also had others who equally worked with us for that period of time, and we've all stuck together very closely as a group of people. And I think that the truth of it is, in a firm like Qualitas, if you join us and you're doing really well, you're someone who's really highly valued. And I think
Right.
that, within that cohort, we don't get a lot of turnover. It doesn't mean as a total firm we don't get turnover because
Sure.
the whole industry gets turnover. But I think at those really senior levels and where you're someone who adds significant value to the firm, it's a formula that has really worked for the people who have been involved. And I think that's reflective in the fact that we've stuck together for 17 years.
Yeah, and also when you're speaking to these overseas funds that are giving you these big mandates, they want to see that stability too, don't they, from the team?
Yeah, they do. And also, even where you've got vehicles like QRI that might
Yeah.
carry a rating from the rating agencies, they're also looking at, what your staff turnover levels are. But they're always impressed with the fact that at those really senior levels, we've really kept the team together. So I think that's an important ingredient for success. And certainly to your point, Greg, the institutional investors are very heavily focused on it as well.
Yeah, no, no, for sure. Hey, Andrew, we have to wrap it up, and I know I've gone way over time. I'm really sorry about that. Just any closing remarks, especially on your outlook over the next few years for Qualitas in particular?
Look, I think I remain really positive about, the markets that we're operating and the position that we have found ourselves. Probably the main thing is that, one really needs to stay focused on ensuring that you're getting the right returns, you're doing the right things, you're not trying to grow for growth's sake alone, but you're taking advantage of the opportunity ahead. And I think we've just got a lot to look forward to in respect of how we're operating the business.
Right, right. Hey guys, I know it's been a long time, whatever it's, I will open it up for just a couple minutes for Q&A. If anyone has anything, you can raise your hand, or I can see the WhatsApp is coming through already to me. Andrew, I'll just ask you a question. If someone's asking, is there, with interest rates coming down in QI, is there a minimum earnings amount on your loans? I think that what he's trying to say is there like a base case floor?
Uh, Generally, the answer is yes to that question. That in the alternate market, you do set a floor on base rates coming down. What I can't say is that every single loan that we've got
Sure.
has that type of floor, and they're all at the same floor. But the general answer is, as an industry, we do set a floor when we write these loans, and it is, yeah. I'd answer it in the positive, in a macro general sense.
Right. Another question I'm getting is on Qual, your funds under management continues to grow at a very healthy rate. Do you see this continuing?
I do continue to see us getting more and more support, and I think that what I'm really more focused on as a firm is what we call our fee earning fund, because which is different to
Right.
just that people give us commitments, because you might have a commitment, but are you earning a fee on it? So
Right.
therefore, really, what's your deployment outlook like? We just announced very recently at a conference that we attended that from last year, our deployment right at the moment is a static snapshot, is tracking at 30% ahead of where it was same time last year. So that would indicate that all other things being equal, our fee earning fund is rising at really good levels as well. So I do think that one should think positively about that growth. Yes.
Right. Another question, and obviously answer it however you see fit. The build to rent business, would you ever consider spinning it out?
What we do, never say never.
Okay.
There's a lot of great companies who I
Yeah.
admire out there that are experts at incubating these sort of businesses and doing things. But I think, you know, hey, we've only been in it for, really 2 or 3 years. We've got so much momentum and such long-term future in it. And, I think it's about really growing it and benefiting from where the industry's at. And, we'll see what happens in the future.
Right. And I'm going to add, this is me adding a follow. Do you also feel that the BTR space is going to grow because of, sadly, the unaffordability creates like a rental market, if you will?
It's exactly my view that
Okay.
more and more, and Greg, there's part of me that says this with a bit of sadness, just so you
Yeah.
understand, contextualize it. But I think there's going to be more and more renters in Australia relative to owners. So 60% of all Australians tend to own their own home, and renting was seen as transitionary.
Right.
It's something you might have done when you were younger,
Right.
but ultimately, our parents taught us your best investment is your house, and you really try and sort of do the maximum you can in that regard. But I think if you go to places like the US and now the UK, that mentality doesn't really prevail as it did 20 years ago,
Yeah.
and people really think about being lifetime renters. And if you look at some of the buildings, certainly that GQ is developing, you could be mistaken for thinking you're in a hotel, right? They're not cookie cutter apartments that have
Right.
been, subdivided and strated. Their entire all of life type of facilities that provide this incredible living standard. And I think that with you throw affordability into it, mobility into it, that
Right.
people want to move around and not have the commitment. I think it's going to become a bigger part of the Australian scene. So I'm very positive on the industry. I think that those that hold other views probably would say we've just not seen it before in
Right.
Australia. But I think if you look at overseas comparables market, it's thriving in other markets, and I just think a lot of the reasons for why it's done really well in, say, the US and the
Right.
UK, I think also prevail in Australia, is my personal view.
Right. Andrew, thank you so much for your time. Kate, thank you so much for working with me on this. Everybody, if you have any follow-up questions, just send them to me and we will make sure that they're answered. Andrew, once again, thank you so much.
Real pleasure, Greg. Thanks for having me.
Easy.
Good to see
Bye-bye.
you. Bye bye.